All right, joining me now is Bank of America CEO Brian Moynihan. Brian, good to catch up with you here.
It's good to be here, Brian. Good to talk to you again.
Yes, so I've been talking to a lot of folks, and there's been a lot of downbeat reads on the economy and the world, but I want to start on something positive. Ahead of the World Economic Forum, you raised your minimum wage to $22 an hour. Why'd you make that move?
Well, we made that move. We have a commitment that started to $15 an hour, then started at $20 an hour, then started at $25, and so this is year two. 20 was 20 and 20, 21 and 21, 22. We were going to do it in October. We moved it up, largely because we just thought it was time to reward our employees. And at the same time, last week we gave the employees who work for the company 3%, 5%, and 7% raises up to 2 years, 2 to 5 years, and above 5 years, under 100,000, because we're trying to make sure that those employees realize how much they're valued and have a career with our company, and it helps on our attrition and all the things. So it pays for the shareholder, it pays for the employee, and works out.
Good, positive initiative. I like to hear that. Now, you're going to reach $25 by 2025?
Yep. Yes, sir.
Has that helped you retain talent?
Yeah, we've been on a long-term program starting in 2010 when the team took over, and they did a great job. We basically made a decision to invest in careers for our teammates. So it's not only the wages, it's the benefits, it's wellness benefits, it's child care benefits, $275 a month per child for our teammates in our lower paid areas. Healthcare has been flat in terms of premium costs since 2011 for employees under 100,000, 50 to 100,000, maybe up 1% or 2%. So we have a long package, but it started back then with a view that in our attrition rate, especially in the processing jobs and call centers, was running higher. That attrition rate went from 20% to 15% to 12% pre-pandemic, dropped to next to nothing during the pandemic, then started coming up. And this is a goal to keep that attrition rate coming down because each point to us is 2,000 people. So it's a lot of work to hire the people and stuff. Now, we don't have a problem hiring people. We hired 7,000 people in the first quarter, so it's not hard to do.
Look, if I work in a retailer and I'm making $15 an hour, why not just come work at Bank of America? And what I'm saying is, shouldn't that be the new normal out there with wages, $22 an hour, if not even higher?
It depends on the company's economic model. In other words, our economic model allows us to have strong profit margin, deliver for the shareholder, and while doing this and stabilize and get the payback in terms of experience and handling customers. The easy tasks that we handled have gone away. So the sophistication of our engagement with customers is different. Now, by the way, with our vendors, they've all gone to $15 an hour 3 years ago. We said, if you're going to provide services to us, you will get there. And we pay them in our contracts to do that because we want them to have the stability of employees. If you're our guard team at our branches protecting our teammates, we want you to be paid well and have a career mindset because that's important.
Okay, now let's switch gears a little bit to the dreaded R word, recession. A lot of executives such as yourself are getting this question right now. But here's Bank of America raising wages. I go to a lot of the stores and the malls in the United States. They're still crowded. What do you see?
Well, so our Michael Hartnett, our economist for our research team, which is number one in the business.
He's the best.
He's the best. And so Michael said it was 1 in 3 last Friday. But you have to remember, Michael would have said, if you asked him a year ago wasn't right. If you asked him pre-pandemic, he would have said 15 to 20% chance. So he moved it up, and that's because he's a believer that the Fed has to take some aggressive rate action. He was the first to call for, I think, 7 rate rises in January, February. People thought he was crazy. Now the whole market came that way. So the idea is, why do they need to move that aggressively? Because inflation's real. It wasn't temporary, it's real. But there's a good aspect to what's going on in America now, which is American consumer is very strong. So that presents a challenge to the Fed, but it's also a good thing to be working against. Their leverage is in great shape. Their account balances have gone up very, very dramatically. Even though stimulus stopped in March of last year, the account balances of our customers at Bank of America have gone up every month since last June or July. Went up faster March to April than they did any other month. If you think about the ability to borrow, the credit card balance is still down from $100 billion to $80 billion. That means the same customers could go back and borrow the money. They're highly creditworthy. If you think about their spending in the month of May, the first 2 weeks is up 10% over last year. They're out doing things. Now, it's shifted more to services, travel, restaurants are strong.
So May good.
That's good. May's good. Up 10% over last year. And by the way, that's overcoming the tax payments. If you remember last year, you could pay your taxes in May. A lot of people took advantage of that. So that's even overcoming that at 10%. Transaction volume at 8 or 9. All that's good. Now, there is a different side to that. Actually, even when you look at our customers' receipts from their paychecks is up 8% year over year. In other words, that we can see, not Bank of America employees, but you can see their periodic payments come in. The good news is that is a great place for America to be relative to the rest of the world. That strong consumer-led economy. Our consumer economy is as big as China's economy. This is a very good thing. The tough thing is with low unemployment, wage growth, then the Fed's job is tougher, and that's a conundrum. So Michael has them slowing down the economy, gets slower in the second half, and then he hasn't announced 24, but my guess it'll start to come out of that. Doesn't go into recession by his current prediction, but the probability went up.
Mm-hmm. All right, so no recession this year, good thing. Maybe not next year, but is that a stagflationary environment?
No, they've got to choke off inflation, and that may drive growth below trend. So our predictions this year are 2.56, next year are 1.56, and that's been down. If you or I talk in January, that'd have been probably 3.5, and so they've dropped the whole point plus off, and so that goes below trend, which means they've actually overshot, slowing it down, and so his thesis is they'll get inflation under control. But again, that consumer is going to make it tougher and easier because, frankly, if people are employed and have money to spend, that means that the U.S. economy will continue to be strong, and that's not a bad thing.
Brian, you're the only Bank of America CEO that I have known in my career, and I was thinking back last night on the crises and the things you've seen, the cycles you have seen. Are you confident that the Fed gets this right? This rate hiking cycle, they get it right, where they can raise rates, bring down inflation, and the economy still grows.
So let's go to the other case. What if they don't? What if we go into recession? Most people even say, if you look at the blue chip economists, none of them have a recession in the next 2 years. They may change that next month, but as of May, when you go down a survey, if you look at street economists, none of them predict negative quarters and stuff. And so, but if they get it wrong, and it was, at the end of the day, with this much money on the sidelines and stuff like that, and the market's already reacted to the rate, they've already priced the 10-year up, even though it's come back down. A lot of the adjustments are being made, and so, that's going to be, so it'll be shallow. But the reality is the rate structure has to move. Why? The economy is bigger than it was in 2019. The unemployment rate's lower. The projected growth for this year is actually stronger than the projected growth was for 20 before the pandemic. Why wouldn't the rate structure be at least the same? And they've got to put it up to normalize that. And when you do that, then you don't have false growth, any inflationary growth. So I think that's a good thing. So I think as you think about it, they have to slow down the economy. It will go below trend. If it goes into recession, the way we underwrite, the way we've driven responsible growth for the last decade plus, we stress test it every quarter. We know what a 10% unemployment looks like. You see it in the stress test. You'll see the results here in a few weeks, I think, and you'll see it, and it shows we have the capital liquidity. And by the way, the whole industry does, and that's a good thing.
That is a good thing. So when you talk, a lot of CEOs and executives and global leaders come to you for advice. When you talk to them now, how concerned are they about an economic slowdown? What do you hear in their voice?
So the challenge for certain people is they're having inflationary pressures and they tried to hold price, and therefore they got pinched on margins, and you saw that come out. But that'll adjust its way through. The interesting thing is a little phenomenon going on earlier in the year and late last year was a lot of people got people from higher inflation economies to come work in the U.S. and say, you have to move on price. You have to get your balance back. If your inputs are going up, your outputs have to go up. Now, the scarcity that was driving this is also a different measure. So people can't get stuff. So if you have a parts manufacturer, you're willing to pay to get the raw materials to get that part out because it's already forward sold. Backlogs are huge. I've talked to a company that makes parts for golf carts, and they're booked through December, the fellow said. Every piece of plastic they can get home to make the golf cart piece, they grab it, whatever the price, they'll pass through the price.
I have been playing a lot of rounds.
That's different, but that's different from somebody else who can't pass through their price. So it's a little different outcome, CEO by CEO, company by company, business model, of how easy it is to pass through that price. The reality is these supply shortages have to get normalized for the economy to normalize, and we thought that'd be over by now. It's still difficult, and that's another one that we have to worry about. But it ebbed a lot, got a little worse, got a little better. So that is something I think the governments of the world have to really get done, which is get those things restarted.
What we're seeing in the markets right now is a market that I don't think a lot of people have seen before. You've seen pretty much everything. Do you think that feeds back into how consumers spend and it is hitting their wealth? Do you think they go and cut back on their spending?
So a lot of people talk about zero trading and digital brokerage and stuff. In the 90s, we had SureTrade and all these companies, and I had them. And if you looked at the Michigan Conference numbers and trading volumes in retail, they ran together. Now, which causes which is an interesting question. So the reality is when consumers, the market's up and they're feeling good, they trade more. When the market comes down, they trade less. So as consumers will adjust to the fact that the wealth effect of their homes, the wealth effect of their things. The reality is they're still up a lot from sort of if you take 19 as a baseline and you look at prices of real estate, is still up a lot. So it'll come down or flatten out. The new homes or whatever the sales today were down a little bit. That's the expected outcome the Fed has to achieve to slow things down. So yeah, they'll adjust, and that's been true for 25 years of having this business. $0 trades are not a new concept. We did in 2006 or 7 and had buses around it. These are not new concepts. Applied differently, talked about differently. The reality is, if people feel wealthy, they spend more. The wealth effect affects a broader base of consumers than most economists know because of the 401ks and other translations. Now, interesting, as the stock market adjusts now that was using compensation, that creates an interesting dynamic because people got paid in stock. I get paid all but my base salary in stock, and it's worth less, but that's not really relevant. But if you think about an average employee at a technology firm, this downdraft, that creates some pressure on them. That'll be interesting to see them adjust to that.
Yeah, indeed, they will. Last, before I let you go, another key theme here, Davos, is cryptocurrencies. I haven't heard Bank of America talk a lot about what they may or may not do in cryptos, but now that I have you here, I'm asking you.
Well, so the reality is that we run a payments business across our platform that moves trillions of dollars a day, and almost all of it's digital. But the thing is, it's in the customers we know, and we've done the KYC and AML, sent it out. So if you think about the blockchain, we have hundreds of patents on blockchain. As a process and as a tool and as a technology. If you think about the question of digital movement of money, 55-60% of our consumer already moves digitally. Zelle payments, we have 54 million digital users. None of this is new stuff.
I'm one of them.
Yeah, but if you think about the question of what was the issues, cryptocurrency things trying to solve, cross-border movement things, those are real issues, and the industry's moving faster to move them. The reality is that we can't do it. By regulation, we're not really allowed to engage. So in the trading side, we could do it, our research team writes on it, but we're not engaging in accounts for people in cryptocurrency and stuff. We're not allowed to, frankly, and because we're a regulated entity, they've said you can't. They've said you have to ask us before you do it, and by the way, don't ask, is basically the tone.
Do you feel as though you're missing out on the next big thing?
No.
No.
I mean, our big thing is helping consumers in America have a successful financial life. Our Life Plans financial planning tool, 4 or 5 million users, only started 3 years ago. That's what you need to do, is get people to learn how to make their money work more for them and help in lives. Then you go to the corporate side. It all moves digitally. It moves at a moment's notice. Real-time payment systems built at the clearinghouse. We're up and operational. Other peer companies are moving money real-time, connecting real-time in Europe to U.S. and Mexico and to Asia is going on. These are things. So we're not missing anything. We're driving payments through the roof.
Well, we'll leave it there. I will say this, though, it's been a pleasure following your career. You've been a beacon of stability every single quarter, just getting after it and doing a lot of good things at Bank of America. Thanks for joining Yahoo Finance.
No, thanks. And the team does a great job, and I'm proud to lead them. And we call it responsible growth, and the team's out there doing it again this quarter. They got to get to work.
Good to see you again.
Thank you.